It's a careful cut, and it's a gradual cut. Those are the words we used, and we use them very deliberately. We pore over this, the language. And the reason is twofold. We've kept the word gradual because we continue to look very carefully at the way in which the erosion of the persistence of inflation from obviously the issues we had a few years ago is going on. We think we're on this gradual disinflation trend, but we have to keep coming back to this. So the word gradual is there deliberately. And then we added the word careful because there are, I'm afraid, a lot of new risks and uncertainties. And they go both ways. This is the point I would emphasize. They could lead to us having, frankly, higher inflation, which we will have to deal with. We're going to have this sort of uptick in inflation. We don't think that's going to persist because it's got some very particular causes which are not related to the really underlying strength or otherwise of the economy. And then we've got things like, tariffs, whether they do or don't happen. Is the weakness of growth more caused by a weakness of the supply capacity of the economy or demand in the economy? And it'd most likely be something of both, but what's the balance? So there's a lot of uncertainty out there.
But just to go back to the numbers, the MPC sees interest rates circa 4.2% in the first quarter 2026. That is only 30 basis points lower than where we are now. The market is way ahead of its skis, isn't it?
Well, by the way, when we say the MPC sees that, of course, we condition our forecast on the market curve. Now, I have to, as you know well, the market curve has been moving around a lot at the moment, which doesn't make the task easier. But it is a conditioning assumption for us. It's not our prediction of what interest rates will be. We produce a forecast which we use. It's an input to the policies, and one of several. But it's where the market was at that point in time. The market has moved around. I think the market's lower today than it was at that point in time.
In terms of growth, though, seen up 0.4% in the first quarter, was seen previously at 1.4% as well.
Yeah.
That is a mighty downtick in growth expectations as well. And I'll just go into a bit more detail from the NPR. Business indicators declined, consumer confidence declined, labour market continued to ease, productivity growth is weaker as well.
Yeah.
All of this is post Rachel Reeves's October budget as well. Has the government made things worse on the economy in the short to medium term, despite their aspirations for growth over the longer term?
Well, actually, the weaker growth pattern goes back to last spring. So growth, we had quite an unexpected, but obviously welcome pickup in growth in the early part of last year. But really, since last spring, it's been pretty flat. So you can't pin it to any one event, I would say.
But your agents, your agents are saying otherwise. Your agents are saying that because of the NIC increases as well, there are real concerns about employment indications, sharp deterioration in hiring intentions. That's got to come through into that prediction.
I was going to come on to that. Looking forwards, yes, we obviously have to factor in, what impact we think that the NIC increase is going to have. Also, what impact other developments in the world and around us are going to have. Now, we haven't actually really changed much our view on the impact of the NIC increase. So impact on growth, impact on inflation, we haven't changed much because what businesses are telling us is essentially continues to be the same, which is, yes, it will have an impact, and of course it does increase the cost of employment. In terms of the channels through which it can come through, whether it's higher prices, lower wage setting than would be otherwise the case, lower employment, lower margins, businesses at the moment are quite cautious in their, what they tell us. So they're rather sort of ticking all of the above boxes because I think they're still very much assessing how this will work.
But the businesses I've been speaking to, both large and medium size, and from what I understand anecdotally from the small companies, they are blaming the budget front and square for the lack of investment intentions in the very short term.
I think there are a number of things going on in the world around us at the moment. So I don't think it's right to point to only one of them. I think the budget is a factor in it, but it's wrong to point to only one thing going on at the moment. There are quite a lot of uncertainties out there in the world at large, and as I say, the weakness of growth actually goes back before the budget.
In terms of global effects of Trump policies and tariffs and trade, clearly it is added volatility as well. I did look at the various boxes to examining what could happen, and it looked a little bit like, yes, it could do this, but then it also could do this. We basically don't know. We don't know how to factor in Trump's policies, do we?
Well, we haven't, and for the very obvious reason that actually nothing's been actually decided yet in the sense of actually coming into effect. So we wait for that to happen. Even then, the effect of tariffs has to be looked at the effect on growth in the world economy and the effect on inflation, and particularly in our case, obviously, we expect to be not the economy that's putting the tariffs on, or maybe even the direct recipient of them, but it will have an effect. Now, I think that in terms of growth in the world economy, if this will lead to a fragmentation of the world economy, that is not good for growth, and we've made that point today in the report. The impact on inflation is more ambiguous because it depends upon what other countries do in response. It depends on what the consequences of those actions and reactions are for trade. To what extent does trade get redirected, and what effect does that have on the price of traded goods? And it also depends upon exchange rate movements as well.
I did read in the NPR that there is an assumption. I want to know if it's the central assumption, because of our the importance of service sector sales and financial community to the United States, that we are less susceptible to tariffs. Do you believe that we are likely to avoid the worst impacts of US tariff policy because of our focus on financial?
Well, I think there's two things I would point to. I'm not part of any considerations of these, so I'll only act as a sort of observer, really. One is actually the UK does not have a substantial trade imbalance with the US. Secondly, you're right. UK trade has a larger share of services in it relative to goods than is true for many other countries. Now, one qualification of that, as many people will point out who look at this in detail, some services, not financial services, some services do depend on goods. So that is, if they're the servicing of a good contract. But you're broadly right that I think there's more services in UK trade. Financial services is part of that. So tariffs, classic tariffs, don't really work in the services world in the same way.
Final question, Governor, just on the short-term inflation outlook. It's going to be very, very tricky going up to the third quarter, getting up to 3.7% to justify further rate cuts, isn't it?
Well, we always have to look out to the 2 to 3 year horizon. So we will go on looking at to what extent we think there are going to be any persistent effects from this bump up in inflation that we're going to see. And we will have to go on looking very carefully at the process of disinflation that's going on underlying that, particularly in services. And we will have to look very carefully at this mix of supply and demand in activity in the economy.